All right, it's happening.
The week starting with another major sell-off.
The market is down over 8% from recent highs.
It was the worst day for stocks this year. It's been quite a roller coaster ride, with the S&P 500 losing over 7% since President Trump's first full day in office.
The S&P 500 has crashed through its 200-day moving average for the first time since November 2023.
What happened? What happened? Give me a diagnosis here.
And maybe you're wondering, is this a buy the dip moment?
Is it time to buy the dip?
Or is this just the start of something much worse?
Are you expecting a recession this year?
I hate to predict things like that.
Honestly, no one knows for sure. That certainly includes me. I have no idea. I will tell you that I'm concerned about the market and about the broader economy. But here's the thing. You don't have to predict the market to make smart moves right now. So here's where we're at. Stocks have taken a hit and things don't look particularly rosy. Inflation is still a concern. The Fed is signaling they might not cut rates as fast as people hoped. And even if they do, that could make inflation worse. And we've got political and global uncertainty up the wazoo, adding to the mess.
Tariff turmoil, the president's trade war, churning volatile markets and provoking countermeasures from adversaries and friends.
Could this be the start of an extended bear market? Sure it could, but could it also be a temporary dip before a recovery? Also, yes. We don't know what will happen next, but we do know one thing: stocks are on sale. Here we have two identical items. One is labeled $100 and the other is labeled $80. Which would you buy? Imagine you're shopping for something you really want: a new TV, some AirPods Pro 2, whatever. If you see them for 20% off, do you run away? No, you buy them. But when stocks go on sale, people do just the opposite. They panic and sell. Why is that? It's the same concept. If you liked a stock or the stock market at $100, why wouldn't you like it at $80? The stock market has been through crashes, corrections, and bear markets for over a century. And every single time it's bounced back stronger. The dot-com bubble, the Great Recession, the pandemic crash, all in the past, all water under the bridge. What's the S&P 500 doing recently? As recently as last month, it was hitting all-time highs. If history tells us anything, it's that downturns are temporary, but growth is long-term. Growth is what everyone is getting up in the morning and working toward. So the situation we've got here is short-term pain, long-term gain. I see you out there thinking about trying to time the market. But let me tell you why timing the market is a losing game. The hard truth is that nobody rings a bell at the bottom of the market telling you it's time to buy, nor do they ring a bell at the top of the market telling you it's time to sell. If you're waiting for the perfect time to buy, you're probably going to miss it. If you take a look at past crashes, some investors do panic and sell everything, but for most of them, by the time they get back in, the market has already rebounded. Timing the bottom sounds great in theory, but in reality, even professionals get it wrong. Consider that if you miss the market's 10 best days in a decade, your returns drop in half, and that the biggest up days often happen right after the worst down days. The lesson here: stay invested. Time in the market beats timing the market. All right, so how do you make sure a market drop doesn't freak you out? It comes down to diversification and asset allocation. Basically, how you spread your investments between stocks, bonds, and cash. If you're all in stocks, market drops hit hard. But as a reward, you get the biggest long-term gains. If you balance your portfolio with bonds or cash, you have more stability during crashes, but lower expected returns long-term. The key is setting an allocation that lets you stay invested without panic selling. For example, if you're a retiree, hopefully you've got more bonds in your portfolio so that you can ride out whatever might happen in the market. Whereas if you're a young investor just getting started, you've got time to ride out market crashes. In that case, maybe you do want to be 100% stocks or close to it. But no matter what your situation, the best portfolio is the one you can stick with. All right, so how do we stay calm in times like this and maybe even take advantage? Well, one way is we can use dollar cost averaging instead of trying to time the bottom. Instead of guessing when to buy, use dollar cost averaging, which is investing a set amount on a regular schedule. This way you're buying more shares when prices are low and fewer shares when they're high, and you do this without the stress of market timing. If you're investing into a 401k directly from your paycheck, you're already dollar cost averaging because the money comes out on a set schedule and goes into the market each and every pay period. Another thing you can do is keep cash ready, but have a plan to use it. If you've got cash on the sidelines, like I do, don't just sit there waiting for the perfect bottom. You need to decide on a plan ahead of time. Maybe you invest a little now and more if stocks drop another 5 to 10%. That way you're not frozen by indecision. What I do is rely again on my asset allocation. So right now, if I'm 70% stocks and 30% bonds, stocks go down, I might be 65% stocks and 35% bonds. Well, then I'll sell some bonds, buy more stocks to get back up to that 70-30 asset allocation. And this way I'm taking advantage of this cash or bond position that I have to buy stocks when they are cheaper. However you decide to do it, have a plan, because a plan beats panic and a plan beats using your emotions to dictate your investing. All right, so what does this all mean for you right now? If you believe in the long-term growth of the stock market, this is likely a buying opportunity. But if this market drop has you freaking out, that might be a sign to rethink your asset allocation. And keep in mind that the goal is not to guess what happens next, it's to have a plan no matter what. So, what do you think? Are you buying the dip or waiting for lower prices? Let me know down in the comments. Give this video a like, it really helps my channel, and thanks for watching.